Good morning and happy Halloween. Welcome to this October 31st, 2023 edition of Trading Places Live. I'm Tom Bowley, Chief Market Strategist at Earningsbeats, and I'll be your host for the next 30 minutes or so as we prepare for the trading day ahead. It's Halloween and we got the Fed meeting started. It started this morning, and we're going to see whether or not this is a trick or a treat. Got a lot for the Fed to think about. I guess this meeting could go in a couple of different ways. Personally, I'm always a little nervous when the Fed's going to speak. Unlike Bernanke and Yellen, Fed Chief Powell's two predecessors, this particular Fed, I don't think is nearly as transparent as the last couple of Feds. And so I always felt going into like the Fed meeting with Bernanke and with Yellen, that it was just a foregone conclusion. We already knew what was going to happen. Never really got, I shouldn't say never, but for the most part, didn't get a whole lot of big surprises coming out of the Fed meeting. But I don't feel that way with the Fed, with this Fed. I feel like we go back to Jackson Hole last year, talk about more pain ahead, or just a more recent meeting where Fed Chief Powell said that there would be higher rates for longer. And he cut out two of the projected interest rate cuts for next year. And you take that history, knowing that maybe he's going to say something that maybe isn't quite in line with what all the Fed spokespeople have been saying over the past few weeks. And that makes me a little nervous. We had a huge GDP report last week. By any account, I think it's 4.9%. You have to go back to the fourth quarter of 2021, I think. I think that was the last time we saw a reading at that level or above. And that was closer to coming out of the pandemic. So obviously some of those readings were a little bit, I don't know, maybe skewed a little bit because of the pandemic. This one, I think, caught a lot of folks by surprise. And I guess there's a couple of ways we can look at this. We could say, hey, it's nirvana for stocks. We've got inflation coming down. And if you look at the long-term history of the stock market, when inflation comes down, the stock market almost always is moving back to the upside. Recently, and we've seen that. Actually, we saw that off of last year's cyclical bear market bottom. We had a big rally as the interest rates started coming back down. But we had a correction. And that's kind of what we're in right now. We've definitely gone down that 10% on the S&P and on the NASDAQ, certainly on the Russell 2000. So no question at this point, we have corrected. But what is the Fed going to focus on? Is the Fed going to focus on the annualized rate of core inflation at the consumer level, which has been coming down consistently for over a year now? It's dropped from 6.7% down to around 4%. I'd certainly say that's on our way to that path, or on the path to what the Fed's looking for, which is that 2% target. Or is the Fed going to focus on sticking with this inflation story where they want to remain ahead of the curve and make sure that they're stomping out inflation, which I've said before, I don't necessarily disagree. I just don't think that they've been very clear about how, I shouldn't say how strongly, because he has made wording. He has talked about wanting to make sure that, they do stamp out inflation. That's their biggest concern. But I guess the methods in doing it, or the editorializing that comes along with these Fed announcements, those are things that I don't think we saw in prior Feds that we do see with this one. So with it being Halloween, and the Fed meeting starting today, we'll have the Fed policy statement out tomorrow. Where does Powell come out on this one? Your guess is as good as mine. I've been speculating. I think with that strong GDP report, maybe the Fed says all rate cuts are off the table for next year. I don't know where he's going to go with this. And more importantly, I don't quite know how the market's going to react. We had a really strong day yesterday, but I've talked about seasonality. It's like the faucet being turned from ice cold to red hot. because the stock market typically performs very poorly from the 22nd of October through the 27th. That's exactly what we saw last week. And then from the 28th through November 5th or 6th, that 9-10 day period, the market's been extremely bullish historically. And this is data going back to 1950 on the S&P 500. We literally go from the worst 6 days, basically the worst calendar week of the year, to the strongest 9 to 10 day period of the year. Go from one to the other right on the heels. It's like a light switch being turned on, or that faucet going from ice cold to scorching hot. Call it what you will. And then yesterday, all of a sudden, we're mired in this huge downtrend. Yesterday starts the bullish period. And let me give you the numbers. Let's first, I'll share my screen. We'll go over what happened yesterday. I mean, I can't make this stuff up. Dow Jones up 511 points yesterday out of the blue. I mean, it sounds a little bit like ice cold water to scorching hot water, right? S&P 500 up 50. NASDAQ up 146. Small caps down, or not up as much, but still up 7 points. Mid caps up 18 points. On a percentage basis, the Dow was leading, no doubt lifted by McDonald's. McDonald's had a really nice report. S&P, NASDAQ, both up about 1.2%. Small caps, mid caps, 0.6, 0.8% gain. Nice day to start this new bullish period, don't you think? And again, I don't know, maybe it just came right out of nowhere. The VIX, let's keep an eye on the VIX. Down below 20, closed below 20. It had closed above 25 of the last 6 trading days before yesterday. Earlier, I did see futures were up. Let me give you the latest here on the Dow and all. We'll see if it's holding on. It's come back down a little bit. Dow Jones still up about 0.06 so less than 1/10. The Spider up 0.2%. The NASDAQ up about 0.1%. And small caps, at least the IWM, up 0.4 or 0.4%. And they were lower last night. The futures were lower. So we did see a little turnaround. I don't know if this is the start of an uptrend, but history says it certainly could be. And I'll show you a couple of charts in just a little bit that I think also suggests that we are at some point, and this is what I've been kind of talking about for the last months, really 2 or 3 months. It's like, yeah, I recognize that there's some issues out there. And I also recognize the breakdowns in price and volume, especially price with volume cooperating, heavier volume, supporting the move to the downside. And there's nothing more important to me than price volume, that combination. So anyway, we were going down, everything looked bearish. So you got to stay somewhat cautious, even if it is historically, we move into a historical bullish period. That's more of a secondary indicator. We need to see things turn around from a price volume standpoint. Maybe yesterday was it. Maybe yesterday was the start. It would be an unusual move in the sense that we didn't go back down and put in a new low. We had a close on Friday and then all of a sudden gapped up, went down a little bit in the morning. I believe all the major indices held that low from Friday and then turned right back around and finished pretty strong. I mean, you can see the Dow right there, gap up, a little bit of weakness, and then move back to the upside. S&P 500, gap up, pull back, but hold on to the low. And then we strengthen into the close. NASDAQ, a little bit more gap up, a little bit more weakness, and then again, rally in the afternoon. One thing I was telling Earningsbeats members yesterday in our weekly market report, one thing that I'm starting to, I don't know if anticipate is the right word. I just want to see it. And that is, I want to see afternoon bullish action. I think it's 7 of the last 8 days prior to yesterday, or maybe 8 out of the last 9 days, we were closing either on the low or very close to the low, which is, that just reeks of downtrend when you're closing at or near the lows. So yesterday was a little bit of a treat. I don't know what today or tomorrow will hold. I don't know if we're going to get a trick or some more treats, but at least we did get off to a good start in what is typically a very, very bullish historical period, the most bullish period. I'll also say not only is it a bullish period for the next 9 days or so, but it also starts the long-term bullish period, the most bullish longer-term period, which runs from the October 27th close through which was Friday, by the way, through January 18th close. That period, the S&P 500 has gone up 62 of the last 73 years. So if you're thinking this is a bear market, we're going to continue going down, it would be one of only 12 years since 1950 that the S&P 500 closed January 18th lower than where it closed on October 27th. So keep all of that in mind. History, I follow it. I do respect it, but it is a secondary indicator. I don't place trades based on it. I just want to be aware of it so that when things start turning like we saw yesterday, I can at least be aware that, hey, this is the time the market starts to move. And if we start getting some more corroborating price evidence, this could be the start of a pretty good run to the upside. All right. But again, we do have the Fed meeting tomorrow, and where it goes from there, that's I don't know. Good question. We'll see. So let's take a look. Dow Jones yesterday up 511. Went through all the numbers here. Saw that VIX down 152. How about the sectors? Well, let's pull up sectors. What happened yesterday? Communication services, financials, number 2 spot. Industrials, number 4 spot. Now remember, historically, financials and industrials lead the market in November. Is this the start? Because these two groups, these two sectors have been very weak. I mean, if we go back 1 week, let's see, financials dropped to there, industrials dropped to there. If we go back a month, we've got financials in the 5th spot, industrials in the 7th spot. You can see just a little bit more weakness. We haven't really seen that strength just yet. October, the first month of the calendar 4th quarter, and I can tell you financials absolutely love the 4th quarter, as do the industrials. But industrials' best month is November, which is tomorrow. So both these groups, which love the 4th quarter, haven't really gotten started just yet, but was yesterday maybe the start. Financials and industrials up there in the top half. I don't know. Also technology. So you had 4 of the 5 aggressive groups in the top 5 spots. So not only were we going up, but it wasn't a situation where Wall Street was repositioning into defensive areas in anticipation of further decline. It was a jump back into some of the more aggressive areas of the market. That will be interesting to watch as we continue to move forward. All right, 10-year Treasury yield. I don't believe we had anything out significantly in terms of economic reports. But let me double check that. Yeah, nothing out really today. Tomorrow, or excuse me, I take this back. I'm looking at Monday. It's Tuesday. So Federal Reserve meeting starts today, actually just started. Case-Shiller Home Price Index came out 15 minutes ago. So let me see what that said. It actually showed that the 20 city adjusted increase was 1% for the month of August. So it's a little bit in our rear view mirror. Here we are getting ready to go into November, and we're talking about August. This is a report that is a little bit dated, but it rose 1%, 1 full percent. The expectation was dropped to 0.7% from July's 0.9% reading. Instead, we went up a little bit. We ticked a little higher. Again, showing a little bit of the sign of resiliency, which helped to lead to that fairly strong GDP, or really strong GDP report we had last week. All right, what else do we have here? The FHFA house price index also for August came in, and it came a little below expectations, 0.6% rise versus the prior month, 0.8%. I don't have an estimate on this one, but this one did drop as opposed to the Case-Shiller Home Price Index, where we saw a slight increase from 0.9% to a full percentage point. Chicago PMI will be out in about a half hour. That is, it's for the month of October. September was 44.1, and we're expecting to see that rise to 45. So we'll see what happens with that in about a half hour. That is it for today. Then tomorrow, ADP employment report in the morning. And then we've got ISM manufacturing coming out at 10 a.m. Construction spending will be out at 10 a.m. as well. And then we've got the FOMC announcement, which will be released at 2 p.m. Expect volatility. No matter what the Fed says, it always seems to be very, very volatile. If you recall, it was September. I'll come back to the 10-year Treasury yield here in just a second. But with the S&P, it was September 19th, 20th, right here. We kind of had an initial move to the upside on the 19th or on the 20th, which was the day of the announcement, which actually was right here. But we went up initially. We had a decent move to the upside after the Fed meeting or after the announcement. And then look at how we finished. We finished on the low at the close. And that started this more significant period of selling. We had the continuing move down. We went back up into gap resistance range and then back down to another new low. So now the question is, have we bottomed? Well, we saw this move up, gap up, and pretty decent action about a week ago. I think it was last Tuesday, and that didn't last, and we went right back down again. So what's going to happen with the Fed? I mean, I could see a number of different things unfolding, and I really don't know which one's going to unfold. I'm going to talk a little bit about some key relationships that still suggest to me that the market's going higher. So I'm going to lean toward either the market responding positively to the Fed or maybe being up over these next couple of days or next day. And then the Fed, after the announcement, the initial move, unlike a month and a half ago, where the initial move was up and then we ultimately went lower. I think in this case, maybe we have an initial move to the downside and then we rally back. Again, based on what I'm seeing from my other indicators, which are much more bullish than the overall price action, which is clearly bearish. Or a third scenario is the Fed does what it's been doing and simply drops another bomb and the market takes another dive. Now, well, let's come back to this in just a second. I do want to go through the 10-year Treasury yield. Right now, we are at 486. So we are down about 2 basis points today, but we were down a lot more earlier. We were down to 480, and now we're back to 486. So coming back up, I think we're just going to meander. I do think this negative divergence here with the PPO going lower and the yield going higher suggests that we're probably going to go back down into the 450s, maybe test the most recent low, and to get a 50-day test, which would unwind that PPO back closer to the zero line. That's what I'm expecting. Now, that would suggest that the Fed is going to maybe announce that they feel a little bit better about inflation. That would send the yields much, much lower. A lot of folks jumping back into bonds. Or it could be maybe something as simple as saying we're not going to take those 2 rate cuts off the board. I think, or them even raising, which is still a possibility. They could raise 25. I think the market's a little bit mixed on whether they're going to raise or not tomorrow. I don't know. My gut feeling is I feel like they shouldn't raise. They should pause. But just knowing what I know about the Fed, I wouldn't be surprised if they raise 25 basis points just to say, hey, we're giving it one more shot, and then announce maybe their expectations to pause from there. This thing could go so many different ways. I mean, I'm really speculating, and I'd like to say it's an educational guess. I'm not even sure I'd call it that. It's just a guess. Don't know what the Fed's going to do here, and what they're going to announce and what they're going to say. Like I said, I think Powell likes to get himself into the game like a umpire in a softball game or baseball game. He likes to become part of the action. And I don't like it, but it is what it is. So watch this closely. I think if we do, by the end of the day tomorrow, if we see the yield start to come back down, say below 480, and we've got we're still holding on to the recent lows on the S&P, I think the bottom could be in. But any kind of a big move down in the 10-year Treasury yield with that negative divergence, I think would, at a minimum, send us higher on the S&P 500 in the short term. But again, we'll see how it plays out and what the Fed has to say. Again, will it be a trick or a treat? I don't know. I did wear my orange today, though, so it's as close as I could come to a pumpkin for October 31st. All right, let's see. What else do we have? Let's move back to the S&P 500 chart. And, I could annotate this and show you. I feel like I'm just going one level at a time, which is, when we were going up, it was like one level of the time at a time for the bulls. And now the bears are having to are trying to get us through one level at a time to the downside. So each support level. So first, we first had this double top right in here. We went up through, we kind of bounced off of it one day and then right through it, came back up through one last time, and then that established support. I'm going to say right here just because of this. And then we know 43.05 was a support from the August high back in 2022. And then we had the recent low right here, which kind of fell right in this gap support zone. And then going down below that, now we've got this double bottom right around 40.50 that I'm watching. And we get below that, then we're going to have probably this 38 level, and then probably 3,700. Then we've got 3,500. Everything to the downside, you've got more and more support levels that we're watching to see if they hold, and bears are trying to take it below those levels. And to the upside, if we start moving back up, we're going to have the same thing we had back earlier in the year. Get back through the 20-day, get back through the 50-day, then clear this price resistance area, and this one, then the all-time high. I mean, look at all these lines on the chart. There's going to be work to be done either way. So I think the short-term picture is obviously we're going lower. The intermediate picture, I think, is just more sideways. We had a nice uptrend. Now we're in a correction. Long-term, I'm still very bullish. Based on what I see on the long-term chart and the history of secular bull markets and what some of my signals are showing, which I'm going to show you in just a minute. Let's keep moving so I can get to those. NDX, you can see, I think I'm not going to annotate it, but the lows here pretty clear around 14.5. Went through it. Can we get back through 14.5? Can we get back through these moving averages? Can we break out of the channel, the downtrend line that guards the top of the channel? Can we get back up above 15,250? Again, it's going to be a lot of questions in both directions. IWM, there's not a lot of questions here. Let me show you one chart, and I think this is really about the only chart you need to see. 160. Maybe there's a slight range. That is about 162. That's where the highs came in prior to the pandemic. Took that big move down, came back up. When we went through that 162 level, it was like a hot knife through butter. Just kept going on and on, took off, never really looked back until about a year and a half later. And we got a double bottom. Where? Well, right around 162, maybe even like 160. And then we had gapped up when we went through. That might be at around 159 or 160, maybe even 158. I don't know. But I think it's pretty clear this area that we are at right now on the IWM is a massive support level. Massive. So what would be really nice is a long tail. Let's say the Fed comes out and the market does get hit in the short term for a couple of days, or maybe just an afternoon. Maybe it's just an hour. I don't know. But what would be very interesting on the IWM is to see an intraday move back into the 150s and a recovery back up to 162 or 163. That might get me a little bit more aggressive in my trading of small caps. Otherwise, right now, I mean, if you're going to do anything with small caps or any of these major indices, in my opinion, I think the the regular ETFs are the way to go. I would be a little careful. If you're going to be into leveraged ETFs at this point, you've got to be willing to take on a lot of risk. And for the IWM, the triple leverage is the TNA, If the IWM closes below, let's say 158, 159, I would absolutely personally not be in any kind of a leveraged product to the upside. Just would not take that chance. If you get a breakdown, you could see a really big drop, and we don't want to be a part of that, especially in a leveraged ETF. All right, transports did finally get an update, which was nice because we just kept going lower and lower. I mean, that was a very significant 10% drop, maybe a little more than 10% in less than 2 weeks. So we needed a bounce, and that, we got that yesterday. From a technical perspective, looking at the chart, can't really call it much more than a bounce at this point. We sold off on big volume. We bounced on maybe moderate volume. We did come down to some key area of support closer to that 13.5 level. So maybe we do get a bounce to the 20-day, but to call a major bottom here might be a little bit premature. All right, chart of the day. First of all, if you like charts of the day, go over to Earningsbeats.com, both plural, Earningsbeats, and scroll down. We've got an area where you can sign up for our free newsletter. Name, email address, hit that subscribe button. You definitely want to check that out. I think some great information is shared 3 times a week, and you can unsubscribe at any time. No credit card required. It's free. It's just something we give back to the community. Make sure you check that out. And then if you want to try our service, 30 days free. This one requires a credit card, but we will reach out to you before the 30 days expires to let you know that it's going to expire. We don't want you paying anything unless you enjoy the service, but check us out. This will be a great time because of all the uncertainty in the market. Now that we're moving into November, things are going to be a little bit dicey because we got a very, very bullish month and we've got a very bearish market that we've been in. It's going to be like a cold front and a warm front meeting, fireworks, storms, thunderstorms. But what's left at the end of the day? We're going to find out over the next 30 days probably. So anyway, check that out. All right, so chart of the day. I think what I'm going to show you here, first of all, is McDonald's. McDonald's reported earnings yesterday. We had kind of threatened to get back up above the 20. This has been a very, very weak group. But I want to show you something. Let's go down here to the relative chart. So McDonald's has been moving lower, and you can see the AD line hasn't been very good. But if you come down, look at restaurants, all of a sudden over the last 2 to 3 weeks, starting to show some pretty good relative strength, which could bode well because this is very consumer oriented, obviously. And so if restaurants start doing well, that could bode well for the market overall if we continue moving up. But the fact that we moved up, McDonald's came out with, let me give you the numbers. They came out with their revenues at almost 6.7 billion. They were expected to come in at about 6.57. So easy beat on the revenues. Earnings were expected to come in at 3. They came in at 319. So they beat top and bottom line, gapped up, and it looked like intraday it was a failure on the 20-day. You see that long tail? So intraday we had a big red-filled candle, and it looked like we were falling apart. We went back through gap support. We were down for the day. We were down over the last few days. We had the lowest low we've seen over the last 3 or 4 days, and then we rallied back into the close to finish above the 20. That and with volume over 6 million shares, that was the heaviest volume day of the last 52 weeks. Big reversal, getting back above a key level. Its industry group is starting to outperform. Some good things happening on this McDonald's chart. Now, if we go back down and close below 254, I say all bets are off. But this is one that after getting beaten up and seeing that it's part of a solid or at least an improving restaurant group, and the stock is showing relative strength to the group, I don't know. I think the restaurant's certainly looking better, and I think McDonald's looking pretty good. So maybe have a second look at that one later, but that's a stock that is looking like it wants to go higher to me. All right, it is 9:30 on the button, so let's take a look at what is going on here. We've got the market just opening. Dow down 44, NASDAQ down 8, S&P up 4. Small cap showing a little bit of relative strength, up a little bit there. VIX down about 1.5%, 1947. The VIX, my study of the VIX long-term with the S&P 500, when it goes above 20, you got to be very, very careful. Occasionally, it'll come back down to 18s and 19s and then go right back up again. So this move down to 19 is nice, but I don't think we're out of the woods, especially with the Fed meeting coming up or with the Fed meeting starting and the announcement tomorrow. I don't know these next 2 days. I wish I could tell you for sure which way I feel we're going. Oh, I wanted to show you one other chart. And this was that relative, the other groups, why I think the market's strong. So let me finish with this one. S&P's been going down, but I want you to look at my growth versus value ratios that I follow. QQQ versus Spider. Okay, rates are going up. Folks are calling for a recession. They're calling for higher inflation. The bears, those are basically some of the basic things that they're calling for. Under each of those growth stocks, we should be seeing money rotating away from growth. Instead, the S&P is setting a series of lower lows and lower highs. QQQ versus the S&P is going higher, a series of higher highs, higher lows. How about large cap growth versus large cap value? Higher high, higher low, higher high, higher low. Mid cap growth versus mid cap value. Higher high, higher low, higher high, higher low. Small cap growth versus value. Higher high, higher low, higher high, higher low. Listen, I'm not making this up. This is one of the things I like to follow. Why is money not going out of growth? If rates go up, growth stocks should get hammered. If rates are going to keep going up, growth stocks should get hammered on a relative basis versus value. We should see these lines going down. If inflation is going to be a problem, what do you do to fight inflation? You raise rates. Again, it's falling back on growth should be going down versus value. Recession, what does that do to earnings? Earnings fall out of the sky. The companies that are based mostly on growth, their valuations are based mostly on growth. Those large cap, all the growth companies, those companies would get crushed if the market's beginning to prepare for a recession. So I'm simply asking the question, why do these ratios keep going up? They didn't do that at the end of 2021. They didn't do that at the beginning of 2022. And throughout that cyclical bear market, go back and look, the growth stocks versus value was going straight down. And then in June, they started to turn a little bit more to the upside, and was one of the reasons why I said we were at the bottom in mid-June of 2022. I said, prepare yourself, cyclical bear market's coming to an end. They're not telling me this market is going to continue going lower. They're telling me the market's going to come back. That's what these ratios are saying. Now, listen, can I guarantee the market's coming back? No, I cannot. I can only tell you that I believe the risk of staying short is greater than the risk of going long, in my opinion. So I'm just waiting for that price action to confirm everything I'm seeing on the chart. If you remember back at the beginning of 2022, when I said we had a lot of problems, and Market Vision 2022, I think it was like January 7th of 2022, whatever that Saturday was, I said the market was setting up for the possibility of a cyclical bear market. I didn't say, I guarantee you the market's going lower. What I said at that time, if you go back and you listen, I can guarantee you one thing. This is what I said. The risk of being long is greater than being in cash. That's all I said. I said the risk, it was too risky to stay long. I didn't say the market was absolutely going to drop 25% to 3,500. Now, I did say that was a possibility, but it wasn't guaranteeing it. Now I'm kind of taking the opposite view. All I'm saying is, based on what I'm seeing, the risk of staying short or even the risk of staying in cash at this point in time, in my opinion, I think that risk is greater than actually being long. We'll see. But that's it for me. Let's go back over one last time here and see what's going on. We're seeing a little bit more selling. We got the Dow down 90 now, NASDAQ down 50, S&P still only down 3. Small caps actually holding up pretty well. VIX moving back up closer to 20. I'll leave you with that. Let's see what happens with the Fed between now and tomorrow and how the market trades off of it. Have a great day, everybody. Happy trading.